Hello, I'm Dave Glover, and thank you for joining me here at InvestorToday.ca. For the next few minutes, we'll be speaking with Mr. Chris Horlacher, who is the founder and managing director of Maple Leaf Metals Exchange. He possesses a chartered accountant designation and is a former senior auditor for Deloitte & Touche, where he provided audit and assurances services to Fortune 500 companies as well as independent businesses. Mr. Horlacher left Deloitte & Touche to aid Euro-Pacific Canada, a securities dealer, during its startup period, serving as CFO before founding Maple Leaf Metals. Today we'll be discussing gold's historical function as currency and how it can be applied today. Well, and welcome, Chris. Thanks for spending some time with us today here at InvestorToday.ca. Where do we begin? I mean, what exactly, if we can pinpoint it as accurately as that, what has been gold's historical currency function?
Well, thanks for having me on, by the way.
My pleasure.
But historically, gold has pretty much always functioned as currency. The first gold coinage that ever appeared on the scene, as far as we know, happened in Lydia around 2,600 years ago. Now, in case you don't know where Lydia is, that's roughly where you would find modern-day Turkey.
Okay.
So it actually even stretches back before then, but that was the first standardized coinage. Gold's use goes right back to the first great civilization, the ancient Egyptians. And in the early days, the Egyptians were more of a nomadic kind of bunch, and they would just travel up and down the Nile, and they hadn't really settled, but they went into the southern regions. Back then it was called Nubia, but today you would call that Sudan. And there are a lot of gold mines in Sudan. And once they took over those resources, the Egyptian civilization really exploded because all of a sudden everybody wanted to trade with them and work with the Egyptians. So then they became the real big center of wealth and power in the early world.
Mm-hmm.
So the rise and fall of civilizations really can be tied to the monetary system that they're on. And I suppose one of the greatest declines and ultimate collapses of a civilization would be ancient Rome. And essentially starting with Caesar, the Julius Caesar,
mm-hmm.
when he rode into Rome and took over, he established a new set of coinage, basically called, it was just a gold and silver standard. There were two coins. One was the Roman solidus, which was a gold coin, and then there was the denarius, which was the silver coin. And if the denarius sounds familiar, that has become, that's because most of the Eastern currencies these days are called dinars, and that's where they got the word from.
Right.
But the solidus and the denarius were a pure gold and a pure silver coin, and they became the most widely circulated coins in the day. Like, they're finding these coins out in China. So they were trusted worldwide, and Rome grew extremely powerful on this set of coinage. But it didn't take long before the arrogance and the hubris of the politicians to take over, and they started to engage in massive, basically deficit financing,
mm-hmm.
Old world style. And they didn't have printing presses back then, but what they would do is they would call in the currency and start debasing it with base metals. And you can just chart the decline of the Roman Empire by the decline of the silver content in the denarius, because it's starting I think roughly about 150 AD, and they started debasing it, and in 150 years, the silver was gone, and so was the Roman Empire.
Mm-hmm.
So the rise and fall of civilizations can be pretty accurately linked to the quality of the currency. So that's been gold's historical role, and so that's why they call them golden ages.
Right.
Usually, when you look at the golden age of a civilization, it's usually because they're using gold as their means of exchange.
Mm-hmm. Well, I guess that brings us to the next question, which is how did our present monetary system come about, and what, or rather, what have been the inherent risks of with our current system?
Well, the currency system that we're on today is not something that was sort of intelligently designed. It's more of a hodgepodge of patchwork, and we're trying to work with a system that broke back in 1971. We're living in the final days of Bretton Woods in a sense, because after World War II, I think it was established in 1946 or 47. There was a conference in Bretton Woods, and they hammered out an agreement whereby all the world would use U.S. dollars as sort of the global currency.
Mm-hmm.
Every nation's monetary supply would be pegged at a fixed exchange rate to the U.S. dollar, which in turn was pegged to gold at $35 an ounce. So, by the transitive property, the entire world was pegged to gold in one way or another. The problem with this system, though, was during the 60s and 50s and 70s, we had the Vietnam War, the Korean War. You had Lyndon Johnson's Guns and Butter, and all the great youth welfare programs, post New Deal, and things that were built up during that age when America basically, gained their superpower status, and then hubris sets in once again.
So what would you say the catalyst was then to take it off the gold standard in the 70s? Was it just the skyrocketing costs of running the government of the United States? Essentially, because again,
they were deficit financing everything, and they were printing more and more dollars in order to do it. And that was really the fly in the ointment to the Bretton Woods system. There was no check against the U.S. government in terms of are they maintaining that ratio of $35 to 1 ounce of gold. And what ultimately happened was, starting with Charles de Gaulle, other countries started redeeming their U.S. dollars for gold at the $35 an ounce price, although, based on the amount of new dollars that had been created over the past decades, the price of gold probably should have been, 2 or 3 times that. So they saw the bargain, and they were cleaning out the U.S. Treasury. So we got, in August 1971, we got the Nixon shock, where Nixon gets on television and announces to the whole world that the U.S. dollar is no longer redeemable in gold. And that's what the U.S. dollar was. The U.S. dollar was a contract to deliver gold. And that was the first major default. Well, maybe not the first major default. I suppose we'd have to go back to the Great Depression for that. But okay, we'll call it the second major default on the U.S. On the U.S. currency, where I guess the first one was when FDR said, okay, well, it's not going to be $20 an ounce anymore. It's going to be $35 an ounce. And then Nixon came along and said, okay, well, now it's nothing. You don't get anything anymore for your dollars. The contract is null and void. So he terminated that.
I guess I just want to know how he was able to do that without this huge hue and cry, not just in the U.S., but around the world, to say, hey, we had you pegged at a specific value, and now your value is, quite frankly, by doing that, you make the valuation of your currency rather arbitrary, isn't it?
Oh, well, absolutely. But at the time, in 1971, the American economy was still the most productive and most powerful economy on the face of the earth. The U.S. government debt was still a very reliable investment, and the country's trade balance had been pretty much even the whole time. So there was still plenty of reason for other countries to go along with this, but that quickly deteriorated as soon as the link to gold was dropped. The country basically started running chronic trade deficits, going ever deeper and deeper and deeper and deeper into debt with each successive administration taking over. So that began the current monetary system in the world today, where it is it's just a U.S. dollar standard, complete fiat, which means money by decree. It has value, and you use it as money because the government tells you to. And if you look at a bill, it'll say this note, which first of all, a note is an IOU. It's a piece of debt, and it says it's legal tender for all debts, public and private. So anybody can settle a debt with this by law, and that's essentially the only thing that gives it value anymore, is because creditors have to accept it as long as the debt is denominated in U.S. dollars.
Right.
So, but there's not much less that the U.S. has to offer now, I guess, when you compare it to the kind of economy they had in the early 70s. They've had chronic trade deficits. The government debt is now approaching 100% of GDP. They've got $100 trillion plus in unfunded liabilities coming due. The national debt has turned from a long-term 30-year financing to short-term 1 to 3 year financing. So it's hard. It's going to be hard for them to keep that ship afloat. I see some major troubles ahead for them.
Mm-hmm. Well, so how does one reconcile the fact that the dollar, because they're printing so much of it, it really isn't worth what they're saying it's worth? And isn't that what's leading to the higher cost of pretty much everything that we're paying for?
Well, absolutely, and you have to consider that money is a good like any other good, and it's subject to the laws of supply and demand. And when you increase the supply of money, that lowers the value of the money, and that is reflected in the inflation rate. A lot of people today, they try and point to rising prices and call that inflation, but they've got that backwards. The rising prices is a symptom of inflation. The inflation is the expansion of the monetary supply. There's lots of reasons for a price to go up or down, but it's only inflation if that price change is being pushed by an expansion of the monetary supply.
So how do we come up with a true valuation then for a specific product? I mean, if I was to go to XYZ company to purchase a new piece of furniture, for instance, and I walked in there with gold, am I going to pay less because I'm using gold, or it's really irrelevant?
Well, because we have an active market in gold, it's easy to always find out what the price of gold is, and then your furniture salesman would work out basically the exchange rate. However, I believe, and many others do believe, that gold is seriously undervalued for the time being, and we're in the process of a correction in the valuation of these commodities. And what has happened is the U.S. dollar is tremendously overvalued, which means these other monetary instruments like gold and like silver have been tremendously undervalued. And if you look, if you go back to say the late '90s, in the height of the tech boom, there was no investment that was more disliked than gold and silver. But that cycle is beginning to reverse, and we're seeing worldwide central banks now starting to replenish their reserves in gold. They're divesting their U.S. dollars and U.S. bonds, U.S. dollars, and euro-denominated securities, and they're starting to fill back up on gold because I think they realize that if their reserve assets deteriorate, then the value of their own local currency will necessarily deteriorate as well, because what is there to prop it up? So they're starting to switch back to gold and to a lesser extent silver.
Well, is that what's led, do you think, because there's been some talk, obviously, in the last few months about how central banks are manipulating the price of gold so that it doesn't outpace their currency values, and also so it doesn't force them to maybe under or devalue their own currencies, and things like ETFs, for instance, which are affecting the value of true gold as well.
Absolutely, and there's some ETFs that concern me. Just looking at the growth in an ETF like the GLD is a bit disconcerting, because the first question is, where are they getting all of the gold or where is it coming from? The growth in the GLD has been absolutely enormous, and they would have to be swallowing up the majority of annual gold production every year in order to physically possess all the gold that they say they have. So there may be a little bit of pyramiding, we'll say, going on in the gold markets. And if Jeffrey Christensen is correct, and he was he testified at the Commodity Futures Trading Commission, he said that in the gold market, the paper gold trades at multiples of the actual underlying physical gold that is available, and he said 100 to 1. So that may be where all of this gold is coming, how they're able to press the price. Because gold has always been a very strong indicator of inflation. When the price of gold is going up, that usually means that the gold is not changing, because gold supply doesn't change from year to year like a paper currency would. Gold, all the annual gold mining production in any given year would only increases the world gold supplies by 1%. So the rate of growth of gold supplies is next to nothing, and you can essentially ignore it. And then there's no industrial use, so everything that is produced is above ground, sitting in vaults. And because it doesn't get used up, we don't have to worry about supply shocks. And for that reason, gold becomes a very useful measuring rod for value. And it's easy to do economic calculation, because now, prices are produced by the interaction between supply and demand. And when supply no longer becomes a factor, then the price of gold is also essentially, or the value of gold is also essentially fixed.
Right. And that's what's happening.
So it's not,
that's what's happening with these ETFs right now. They're basically a mechanism by which they can keep the price of gold at a regular rate, or at a rate that they'd like to have set, or are they looking to drive the value of gold down?
Exactly.
Just so
well, they may not be looking to do that intentionally. They're probably just money managers trying to ride, hitch their wagon to gold and ride it on the way up. But the gold, quote unquote, that may be in these funds may not be actual physical gold that they have title to. It may be gold certificates or other kinds of claims on gold that there might be significant counterparty risk. And when as these markets continue to kind of unravel, we're going to see more and more of this stuff happen. Like just looking at what happened with MF Global, nobody really saw that coming. It was just it hit like an earthquake, and it was over. And so that's usually how these financial frauds get discovered. It's all of a sudden, out of the blue, and everybody loses their money.
Yeah.
So as the price of gold continues to rise and more people become interested in taking physical possession, that push for physical possession is going to crush the fractional reserve gold, paper gold system that has been built up. And that is really the original kind of currency. Was going back to the goldsmith tale. The goldsmiths would issue more paper gold than they had gold in the vault. So all of this paper gold floating around in the world is artificially increasing the supply of gold, first of all. But it's one of the oldest tricks in the book,
right?
As far as currencies go.
So if you're an investor, then I'm going to ask you this. Then, as an investor, because a number of our listeners obviously are people who are investing and thinking of places to invest. Obviously, then a gold ETF isn't where you're going to want to put your money, because, as you say, it's a promissory note. It's a promise to pay the bearer, if you will, a certain amount of gold. But if everyone wants their gold all of a sudden, then
the ETF would get eaten alive, and only a fraction of the people participating in the ETF will actually get physical gold. And now that may also be why many of these ETFs set the redemption minimums for physical so high. I know. I think there's a popular gold ETF in Canada here, I think it's the Claymore ETF, but you need to have over $1 million in units before you can actually redeem for physical gold.
Right.
So they set the redemption limits very high, and so they know that any unit holder that has under those limits, they're never actually going to have to give them any gold or silver. So who knows what the fund managers may be thinking or doing at that point. So for me, which is why I started my company, I recommend taking physical possession, keeping it at home, or with a dealer you can trust in a good segregated or allocated storage program. The other kind, those are the safest investments you can probably make right now, because in a segregated account you have basically a box with your name on it, with your bars and coins sitting there. In an allocated account, the account, it's one big account, and there are lots of gold bars and everything in there. But we know that gold bars are serialized; they're numbered. So those individual numbered bars will be registered to certain investors. So you should get a statement with the list of bars and bar numbers, and then your monthly storage fee. Now, the nice thing about segregated and allocated storage is that those bars and those coins are not kept on the books of the storage company.
No, they're yours.
They are. They're legally yours. Now, in a bankruptcy, which is what everybody is afraid of right now, that cannot be touched, which is, I think, probably the most important thing that people need to be thinking about right now, because, again, going back to MF Global, people thought that money was theirs, but when they read the fine print in their contract, it wasn't, and they lost. So it's important to know who legally has title to your investment.
Right.
And with the segregated or an allocated storage program, you have legal title.
So would you recommend that as sort of one of the fixes that people can look to for this current economic crisis? I mean, obviously there are a lot of things that have gone wrong with the way the system is, and can we talk because we only got a couple of minutes left, can we talk a little bit about what is working right now? I mean, you've talked obviously about segregated gold reserves and making sure your gold is safe as your gold, but what other measures do you think can be taken right now to try and maybe take some of the sting out of our economic crisis? Because a lot of this is really, I think, driven by the media. There's a lot of really nervous people out there, and a lot of that uneasiness, I think, is media-driven.
Oh, absolutely. And there's always that great, big, massive investors out there that are constantly chasing the bandwagon. And the media basically is driving the bandwagon. So we can expect to see movements in the marketplace that are following what people like Jim Cramer are telling people to buy and sell. So the other thing too is that most market actors are trained in Keynesian economics, and they want stimulus. They like stimulus. They hope for stimulus. That they think stimulus helps the market. So whenever there's an announcement of stimulus, expect the markets to go up.
Right.
Whenever people are hoping for an announcement of another round of stimulus and they don't get it, then expect markets to go down. And we just saw that recently, last week, where we saw a big decline in the markets, and that was basically because Ben Bernanke was everybody was hoping he would announce QE3, and he didn't. And that should actually be bullish, because it would suggest that they're not going to continue debasing the U.S. dollar, and then we should start seeing some stability. That caused everybody to run out of stocks and everything else. So it's interesting, but if you understand the mindset, then it helps you understand how things are going to be playing out, and how to get yourself prepared. Now, as far as investments, gold and silver are obviously good places to be right now.
Mm-hmm.
But really, you also want liquidity, because as these markets are going up and down, the volatility can be a great asset to people who have liquidity, because it'll allow them the opportunity of snatching up great companies, great stocks, and any kind of good investment, high dividend yield companies or good growth companies
Mm-hmm.
at bargain basement prices. So
Right.
Liquidity is your friend. You definitely want to, you want to be in cash. I know cash is currently being debased. I don't think we're going to see massive inflation just yet.
Mm-hmm.
But definitely, if you have bonds, now is probably the time to be thinking of leaving the bond market, because bonds right now are incredibly overvalued. Interest rates are at the floor, and if they can go any lower, I would be surprised. They're going to keep trying to push them lower.
Uh-huh.
But again, take those opportunities as a way to sell out of bonds, get back into cash, and start looking at investing in precious metals. And also keep your eyes on solid companies, multinational companies with dividends, good cash flow, and low PEs, and start snatching those up anytime there's a downturn.
Well, I want to thank you for that. I also want to thank you for joining us today here on InvestorToday.ca. We've been talking to Chris Horlacher, and we have been talking about gold's historical occupation, I guess, as the currency of choice, or the currency of valuation anyway, how that has changed, and it looks like we may be seeing a shift to that. I don't know if that's going to be the final outcome. But I want to remind the viewers, you can contact Chris Horlacher. Chris, he is C. Horlacher, that's HORLACHER, at mapleleafmetals.ca, or you can check out their website at www.mapleleafmetals.ca. Chris Horlacher is a professional. He's an accountant, former senior auditor with Deloitte & Touche, as I outlined in the introduction. Chris, while I was talking to Redmond Weisenberger over at the Mises Institute, we were talking about the possibility of maybe our next show being a discussion on the separation of state and economy, and I think that's where we were leading to as we sort of came to the end there.
Well, I certainly hope so. I think it's a great idea. It would be... I think that's really where our problems really began, because at the turn of the century, especially during the Great Depression, the world was convinced that the government needed to be the ultimate decision maker
Mm-hmm.
and take an active role in the economy, managing, who the winners and losers are going to be. And, they did a great job marketing it, but when you really boil it all down to political theory, this is fascist economics. This is
Mm-hmm.
corporatocracy and cronyism. So, the fascist economy was always a tightly controlled, tightly regulated, government-managed marketplace, and that's what we have today. And it's obviously not working. So it didn't work for any of the fascists back in the 30s and 40s. It's not working for us now. So we need to revisit the idea of what it really means to be in a free market.
Absolutely. And we'll touch on that on our next broadcast. For those of you that have tuned in, I want to thank you again. This is InvestorToday.ca. I'm your host, Dave Glover. We'll talk to you next time. Thanks for tuning in. Bye-bye.